Welcome to the deep dive. You've shared the sources, we've done the triage. Today, we're digging into Similarweb's Q3 2025 earnings call. It happened yesterday, November 12th. And this one, well, it's got a central mystery, doesn't it? How does a company announce better profits, generate cash, lock down a huge backlog of future revenue, and then see its stock just get absolutely hammered?
It's a head scratcher on the surface.
Similarweb delivered on the bottom line. They signaled a pretty clear strategic shift, but the market reaction was brutal. Sold off almost 17% intraday.
It really is a perfect case study, I think. Investor short-term focus versus maybe a longer-term strategic plan playing out. The immediate issue, those headline numbers, it was a classic mixed print.
Right.
They definitely beat on the bottom line. Non-GAAP EPS came in strong at 0.05 cents.
Yeah.
That easily cleared the 2 or 3 cent consensus. So great job on efficiency there.
Okay, good start.
But the top line, that's where the panic seems to have set in. Revenue was $71.8 million. Now, that's up 11% year over year, which isn't terrible, but it was seen as just a tiny miss against the low end of the street's target, which is like $71.9 million.
Wow. Okay, so a fractional miss. In this market, though, a miss is a miss, even if it feels like a rounding error sometimes.
Exactly. And the market just seized on that, prioritized that slight shortfall over pretty much everything else.
Yeah, we saw that stock drop hard. Investors basically signaling, hey, we think growth is slowing and we're not quite buying this efficiency story yet.
Right.
But okay, let's try and tune out the noise of one bad trading day. We need to look at what management is actually doing, what they're executing on. That pivot to profitability, it's not just talk, is it? It seems real.
No, it looks very real. Their non-GAAP operating profit hit $4.6 million. That's a 6% margin. And the GAAP loss was, really quite modest.
And underpinning that, you've got the cash flow, right?
Absolutely. The free cash flow story. Yep. SMWB generated $3.7 million in normalized FCF this quarter. And get this, that's the 8th consecutive quarter of positive free cash flow.
8 quarters straight. That is huge.
It is. It means they're self-funding their growth, their AI investments. They don't need to go back to the market for cash. And they're sitting on $65.5 million with zero debt. That's a strong position.
Okay, so solid financials. But back to that revenue softness. Management's explanation was deal timing volatility. They pointed to, quote, early recognition of some LLM evaluation revenue in Q2 that they thought would land in Q3. Now, deal timing volatility can sometimes be corporate speak for, well, we missed, right? How plausible does that explanation sound, given the market skepticism?
It's plausible. But it ties directly into the second big area of investor concern, which is those retention metrics. This is where the story gets a bit more complicated, I think.
Okay, let's talk retention.
Yeah, the key metric every SaaS investor watches.
Yeah. Net
revenue retention. NRRs. It tells you how much your existing customers are spending year over year. Similarweb's overall NRR, it dropped to 98%.
It's down from 101%.
Right. And for their big customers, the crucial ones spending over $100K. NRR slipped there too, from 111% down to 105%. Still over 100, but trending down.
Okay. NRR dipping below 100% overall. That's usually the big red flag for SaaS investors, isn't it? Suggests churn is maybe starting to outweigh the upsells. How does management spin that? How do they argue it isn't a major warning sign about product stickiness?
Well, that's the core tension, exactly. Management's counter-narrative is basically, look, yes, NRR is down. Part of that is some minor seat optimization, maybe smaller customers tightening belts. But the bigger reason they argue is the nature of these massive new AI deals they're signing.
The LLM evaluation deals you mentioned.
Precisely. These are high value, often one-time LLM evaluation deals. Let's call them AI pilot contracts. They belong in cash right now, which is good. But they don't count as annual recurring revenue, or ARR, until they hopefully convert into long-term sticky subscriptions later.
Got it. So the argument is NRR looks temporarily weak because this big new growth engine, these AI deals, they're currently being booked outside that standard ARR metric the market focuses on.
That's the argument. Management is essentially saying the growth is happening. It's just the accounting bucket hasn't caught up yet.
Okay, if that's the story, we need some proof, right? Proof that those AI pilot contracts are likely to stick around and convert. And I guess that proof has to be in the backlog.
Exactly. That's the structural green flag the market seems to be, frankly, completely ignoring right now. It's the remaining performance obligations, or RPO.
Right, RPO. Explain that quickly for everyone.
Think of RPO as the total committed contract value that hasn't been recognized as revenue yet. It's the money clients have to spend with you based on signed deals.
So future guaranteed revenue, basically.
Pretty much. And Similarweb's RPO, it grew 26% year over year to $267.6 million. That is a massive backlog.
26% growth in backlog. Okay, that's strong.
It is. And there's more. 58% of their current ARR is now locked under multi-year contracts. That's up significantly from 45% just a year ago.
So longer deals, more commitment.
Right. It signals better durability, improved long-term visibility. It directly contradicts a purely bearish read based only on that temporary NRR dip. The contracts are getting longer, the backlog is swelling. It doesn't sound like a business in trouble.
That's really compelling evidence that the enterprise clients, the big fish, are locking in. And speaking of enterprise, who's signing these deals? Did we get detail on customer growth?
We did. Total customers grew 15% year over year up to 6,127.
Okay.
But more importantly, those biggest customers, the $100 K plus ARR group, they grew 13% to 447. And now they account for 63% of total ARR. That's up from 60% last year.
So they're successfully moving upmarket, shifting from lots of smaller customers to fewer but stickier, higher value enterprise deals. That's textbook SaaS strategy, isn't it?
It absolutely is. And this whole strategic shift seems to be powered by their focus on Gen AI. Management was really explicit about this on the call.
What did they say?
They said Gen AI data and solutions are now their fastest growing revenue streams. And get this, ARR, just from their specific Gen AI intelligence products, already crossed $1 million since launch.
Wow, okay. $1 million ARR already for a new product line. That's a quick start.
It is. And we also saw strength in their cross-selling. App Intelligence ARR is apparently nearing $10 million now, and the CEO confirmed most of the new App Intelligence customers are actually existing SmallSrater. Similarweb customers adding that product on.
So the land and expand model is working. They get a foot in the door, then sell more products to those larger clients. Makes sense.
Yeah.
They also mentioned some new product launches, right? Web Intelligence 4.0.
Yeah, and some updates to Shopper Intelligence too. They're clearly still investing in the platform.
Okay, let's pivot to guidance, because this is where management really, I think, showed their hand on the strategy, right?
Absolutely. This is where they made their priorities crystal clear. First, the full year 2025 revenue guidance, they just reiterated it, $285 million to $288 million.
No raise on revenue.
Nope. And that immediately confirmed the market's fear, or at least suspicion, that top-line growth is either slowing down or management is being very conservative.
Okay, so they proved they can cut costs, drive profit, but the question becomes, can they guide growth higher? If they didn't raise the revenue target, they must have done something else positive with guidance, surely.
Oh, they absolutely did. They significantly raised their full-year non-GAAP operating profit guidance.
Raised profit guidance. By how much?
Quite a bit. The old range was $5 million to $7 million. The new range, $8.5 million to $9.5 million.
Wow, okay, that's like a 60% hike at the midpoint. That's a serious increase.
Huge increase. And they attributed it to AI-driven efficiencies internally, plus disciplined execution, which included, interestingly, pruning some underperforming sales reps.
Ah, the old trimming the fat move.
Pretty much. So management is very clearly signaling we are choosing margin improvement and operational discipline over just chasing top-line growth at any cost right now.
Well, quality over quantity makes sense in this environment. We should also probably mention the CFO change that was confirmed, right? Jason Schwartz is out, Ranveer is in starting in December.
Yeah, that's important context. A CFO transition often brings a bit of near-term conservatism into financial forecasting and guidance. So that could also be playing a part in that steady revenue outlook.
Good point. Okay, let's zoom out for a sec. What's the bigger picture here? The environment they're operating in?
Well, the whole digital analytics space is facing kind of mixed demand, isn't it? You've got companies scrutinizing their marketing spend more carefully.
Right.
Plus, there are structural shifts happening in search, like Google's AI overviews potentially leading to more zero-click searches. That puts pressure on companies selling website traffic data, which is part of Similarweb's core offering.
So that's the headwind. What's the tailwind then?
The tailwind is definitely the structural opportunity around AI itself.
Yeah.
Enterprise demand for high-quality, reliable usage and traffic data to train large language models, LLMs. It's surging. Similarweb is right in the thick of that, targeting this massive new market.
But the big question is, can they capture that demand fast enough? And crucially, capture it as recurring ARR that the market values, not just these one-off pilot deals.
Exactly. That tension explains the stock performance disconnect almost perfectly, I think. This stock has been hammered compared to cloud peers this year, down massively.
Yeah, it's really underperformed.
Yet, you look at the Wall Street analysts, the sell side, Consensus is still pretty bullish. Moderate or strong buy ratings, price targets way up at $13 to $15.
So analysts see the long-term potential?
They seem to. But the buy-side reaction yesterday, the actual investors, it screamed skepticism. Skepticism about whether that NRR can recover consistently, and skepticism about the timing. When will these big AI pilot deals actually convert to recurring revenue?
So the market's basically saying, prove it.
It's a classic show-me story right now. Investors seem to appreciate the free cash flow. They definitely notice the raised profit guidance. But they're punishing the stock hard for that softer NRR number today. They're saying, yeah, the LLM data story sounds exciting, but we're not going to pay a growth multiple for it until we see the proof in the recurring revenue numbers.
Okay. So if that RPO growth is the big structural green flag the market is ignoring, how do we potentially capitalize on that contradiction? Let's shift gears. Put on your sharp-elbowed hedge fund analyst hat for a moment. It's time for our This Is Not Financial Advice segment. Give us a wild but plausible trade idea based purely on this earnings call and the reaction.
Okay, this is not financial advice, but let's game this out. The trade here hinges entirely on management executing against that AI pipeline they keep talking about.
The very big deals they mentioned.
Exactly. Management specifically mentioned having very big deals in the works, selling data to LLM companies. We know these often start as these evaluation contracts, the pilot deals, that the market is currently ignoring in NRR calculation. So the trade idea, it's a leveraged long position, think maybe long-dated call options, something with some time on it. You're betting that management successfully converts one or more of these very big deals from that one-time pilot fee structure into a proper multi-year ARR subscription. And crucially, that they do it sooner than the market currently expects.
So you're trying to front-run the proof point.
Precisely. You take advantage of this currently depressed stock price, which is down because of the NRR fear, to build a position before that proof arrives.
And when do you think that proof might arrive? What's the catalyst?
The hypothesis is that the Q4 earnings report, probably landing around February next year, will be the main proving ground. If Similarweb comes out then and announces, say, a multi-million-dollar LLM deal conversion that's now hitting ARR.
That would change the narrative fast.
Instantly. It addresses the NRR fear head-on. It confirms the structural shift to AI data is real and recurring, and you'd expect a pretty swift repricing of the stock, potentially back towards those higher analyst targets. The bet is that the current low price is an attractive entry if you believe management can execute that conversion in the next, say, 90 days or so.
Interesting. Okay, let's quickly recap the key takeaways for you listening. Similarweb delivered a crucial beat on profit, showed strong operational efficiency. Good signs there.
But they had that slight miss on revenue, which seemed to trigger the market panic.
And the real battleground seems to be NRR versus RPO. Net revenue retention looks soft right now.
But management claims that's just a timing issue tied to these big LLM data pilot contracts. Meanwhile, the remaining performance obligation, the backlog, grew a very strong 26%, suggesting underlying commitment is actually growing.
So, expert, let's leave the listener with a final provocative thought.
Okay, here's something to chew on. Management is clearly prioritizing margin gains now, and they're building that multi-year contract visibility through RPO. That usually results in a higher quality stock over time, even if growth slows slightly.
Right.
So the question for you is, what specific level of net revenue retention, maybe in the Q4 results or when they guide for 2026, will finally be enough? Enough to convince the market that this LLM data conversion story is structurally sound, and that the current NRR dip really was just a temporary accounting thing.
That's the number to watch, isn't it? That NRR figure over the next few months will tell us if this deep dive was looking at a stock that's a falling knife, or maybe one that's a coiled spring ready to bounce.
Time will tell.
Indeed it will. Thank you for joining us on the deep dive.